Okay, guys, we're going to get going now. So, welcome to today's lesson. This is day one out of the 3-day consolidation classes. I'm Faiz Khan, and I will take you through understanding a consolidations to quite deeply. The structure of the next 3 days is as follows. Today, we will be covering an overview of group accounting. Tomorrow, which is day two, we'll be covering the details or the key principles within IFRS 3 and how to account for intercompany transactions. On day three, we will then jump and do a question paper. The question paper I selected, I can't remember the one I selected, but it's one of the tests. So it's a test one from CTA 2, FAC 4864. So it's one of those test papers. I cannot remember which one I selected, but that's basically how we're going to work through over the next 3 days. Um, so to jump in, to start, one of the important questions you need to ask yourself is, what is the purpose of group accounting? Now, remember, we are dealing with financial reporting. The objective of financial reporting is to provide users is to provide users with financial information that is useful for decision making. Now, there are two types of users. You get primary users and you get secondary users. The primary aim is to provide primary users with financial information that is useful for decision making. Now, the question is, who are our primary users? Our primary users are basically current and potential investors, current and potential lenders, and creditors. Okay, so just keep that in mind. So the ultimate aim of financial reporting is to provide primary users of financial statements with financial information that is useful for decision making. Now, that is the basis of how group accounting or the purpose of group accounting. Think about this. You are an individual. You want to make some investments to perhaps grow your wealth or for whatever reason. So you want to make investments. The way you're going to make investments, there are various options. One of the options that you have is to invest directly into a company by acquiring a company's shares. The way you will acquire a company shares, well, at least here in South Africa, is to acquire shares on the JSE. Okay, so the Johannesburg Stock Exchange. Now, let's say you want to invest in Shoprite. The only Shoprite entity on the JSE is the Shoprite Group Limited. Now, the Shoprite Group Limited is not only Shoprite, but it is Shoprite, Checkers, and whoever else they have. Okay, like that friendly store, can't remember the name, but basically 7-Eleven. I don't know if you guys know of 7-Eleven. 7-Eleven, they changed, but Shoprite basically owns 7-Eleven, or the new name that they have. So when you invest in Shoprite, you're not only investing in Shoprite, the company on its own, but you're investing in all its other subsidiary companies. So for you to make a decision that is useful, you need financial information about not Shoprite, but about the Shoprite group. And that is the reason why we basically deal with group accounting. So I just need you to understand that. Link the conceptual framework with group accounting. The conceptual framework, in the conceptual framework, it tells you the objective of financial statements or financial reporting. The objective of financial reporting is to provide users with financial information that is useful for decision making. The main users that we provide information for are our primary users. Our primary users are your existing and potential investors and your existing and potential lenders and creditors. So you as a potential investor or even a current investor, for you to know whether you want to invest, whether you want to take out your money, or whether you want to stay in, so you can either buy more, sell, or remain. You need, in order for you to make that decision, you need information to make that decision. And that is where the financial statements come in. Financial statements is not the sole body of information. It is just one part of the information, but it plays a key role. So when you want information that is useful, you can't only get information of ShopRite the company. You need information of ShopRite the group, because that is the entity you are investing into. So just keep that in mind. If you can see that, you can understand that purpose, you will slowly be able to pick up and understand the bigger picture. So just keep that in mind. So I just wanted you to cover that, what is the purpose. Now we're going to jump into group accounting, and I'm going to share Excel, because as I'm going to speak in Excel, I'm going to document what I want to say, and then I'll share the Excel file with you as well. I didn't want to prepare the Excel before the time. I wanted to do it while I was actually doing the lesson. So just give me a moment, and then I'm going to share Excel with you. So you should be able to see my Excel file. So let's understand the bigger picture of group accounting. And this will play a role going forward into day 2, because this will give you an understanding of why we eliminate intercompany group transactions. So remember the whole purpose. The purpose is to provide users with financial information that is useful for decision making. We don't want financial information of an individual company. We want financial information of the group as a whole, because you, as a current investor or as a potential investor, you are investing in ShopRite, the group, not ShopRite, the individual company. So please be cognizant of that. So let's understand group accounting, okay? So I'm going to share this with you. So here we have a company over there. We have another company over here. And then we have another company over there. So you should be able to see 3 circles at this point in time. Let's assume this is a parent with its 2 subsidiaries. Okay, so to bring it more, make it more real, let's assume this is ShopRite, Checkers, and I'm going to call it 7-Eleven. Okay, so on an individual basis, it looks as follows. On an individual basis, it looks as follows. So here we have ShopRite, the company. Over here we have Checkers. And over here we have, I can't now remember, I'm just going to call it 7-Eleven. Okay. So we have ShopRite, which is a separate company. We all know ShopRite. We saw that red and yellow store. Then we all know Checkers, which is the green and white store, or green and whatever color it is. And then we have 7-Eleven. Now ShopRite acquired Checkers, ShopRite acquired 7-Eleven. Now, with most retailers, the purpose of them acquiring various entities, for one reason, they want to get into different markets. So for example, with ShopRite was targeting a certain segment of the market, where Checkers is targeting a different segment. So Checkers is competing with the likes of Pick and Pay and perhaps Woolworths. ShopRite not competing with Pick and Pay, but ShopRite doesn't cater for the same market segment. Similarly, with 7-Eleven, 7-Eleven was your convenience stores. So each entity in the group is targeting a different segment. But more specifically, with with ShopRite owning Checkers and 7-Eleven, before ShopRite owned Checkers and 7-Eleven, 7-Eleven would order Coke separately, Checkers would order Coke separately, and ShopRite would order Coke separately. But now, with ShopRite owning Checkers and 7-Eleven, ShopRite as the group will actually, or ShopRite as the entity with owning all of those companies will buy all the Coke. That will give them a competitive advantage because now they have even more power because they're buying the three entities. And in doing that, ShopRite now has all the Coke, but ShopRite is not going to sell all the Coke. The Coke is going to be sold by ShopRite, Checkers, and 7-Eleven. So what do? ShopRite would then sell on that Coke to Checkers and sell that Coke on to 7-Eleven. And that is giving rise to transactions between the companies. Now, from a separate entity perspective, it will look as follows. So from a separate entity perspective, it's going to look as follows. So I'm going to add in some more drawings over here. So we're going to have ShopRite transacting with Checkers, ShopRite, and then ShopRite transacting with 7-Eleven. Here we go. I need to turn this. So understand this from a real world point of view. How did this come about? ShopRite owns Checkers and 7-Eleven. Remember, a company buys into another company for different reasons. One of the reasons is to tap into markets where they're not. So, for example, like I explained, ShopRite acquires Checkers. Why? Because ShopRite want to compete with Pick and Pay. Now, ShopRite's clientele is not Pick and Pay's clientele, so the way they compete with Pick and Pay's clientele is by having Checkers, because Checkers, Pick and Pay, and perhaps Woolworths is on that same level. Okay, although Woolworths won't see it that way, Checkers and Pick and Pay compete with Woolworths. Okay, where ShopRite is not going to compete because that is not the target market. So that's the one reason they buy other companies in order to tap into markets where they are not. Another reason, it gives them buying power, because now ShopRite is buying for themselves as well as for Checkers. So that is a large volume of Coke, a large volume of cool baked beans, a large volume of everything. So therefore, they will have the power when they go to the supplier and they will tell the supplier, listen here, give me a better price. But that's management accounting. Okay, I just wanted to get the real world perspective. But now from an accounting perspective, ShopRite acquires all of this. But ShopRite is not going to sell all of this. The various entities is going to sell it. So what do? They need to transfer from ShopRite to Checkers, transfer from ShopRite to 7-Eleven. And that is and that gives rise to transactions between companies. But because ShopRite is a separate entity on its own, and Checkers is a separate entity on its own, and 7-Eleven is a separate entity. When I say separate entity, a separate legal entity. So from the separate financial statements, the transaction is totally fine. There's no adjustments that need to be made. Absolutely no adjustments that need to be made, because from a separate entity perspective, from a separate legal entity perspective, the transactions is fine. So nothing we need to do. But now comes the end of the year. We need to prepare financial statements that is useful for decision making, that is useful to users for decision making. Remember, who are our users? is our primary users, which are investors. Investors can't invest in Checkers. Investors can't invest in 7-Eleven. Similarly, investors can't invest in ShopRite, the separate company. As an investor, if you want to invest in ShopRite, you must take the whole package. So now we need to produce financial information that represent the group. And this is how the group will look. So I'm going to get another shape. So this is how the group will look. So now that, what just happened? Let's just see if I can make this transparent. How would I make this transparent now? Format. I just want to make this thing transparent here quickly so we can actually see the group. Oh, here we go. I'm just making it transparent. So there we can see the group now, okay? So as you can see, now the square block is ShopRite, the group. So this is ShopRite, the group. ShopRite Group Ltd. And that is where group accounting comes in. So before the square came around, we had 3 separate legal entities. The transactions between themselves was totally fine. Now when we prepare group financial statements, it is a square block around all 3 entities. We now have what we must assume from a group accounting, that the square block is acting as one economic entity. So ShopRite plus Checkers plus 7-Eleven makes up ShopRite Group Ltd. ShopRite Group Ltd, which is made up of those 3 entities, is one economic entity. Very, very important. So the group acts as one economic entity, not 3 economic entities, but one economic entity. So what does that mean? What does having one economic entity mean? It means we are only concerned about transactions that is transacted with people outside of the group. We're only concerned with transactions that takes place with the one economic entity. So the transactions we are interested in are the following. I'm going to get my some more diagrams. So we are interested in those transactions outside of the group. So who the group transact outside and who transact and those that is outside that transact with the group. So just keep that in mind. The transaction we are looking with is all transactions that the group transact not with each other, but with those outside of the group. So this is all the transactions we are interested in. Oops. Control V. So that entity we're trying to get, so any transaction, and you get the picture, just do that also. So that is basically, so any transaction that is a transaction outside of the group, those are the transactions we are interested in. And any of these transactions inside of the group, we need to remove. We need to eliminate. Why? Those transactions did take place, and they are relevant for the separate financial statements. But from a group perspective, they are not relevant because the group is acting as one economic entity, and hence you cannot transact with yourself. And the only transactions we are interested in is transactions with those other than ourselves. It is transactions with those outside of the group. So just keep that in mind. If you can just picture this each time you do a question, you need to ask yourself, is it a transaction outside of the group? If it is a transaction outside of the group, that is what we want. If it's a transaction within the group, then we need to eliminate them. So just keep that in mind. Um, do we have any questions at this point in time? If you have any questions, just pop in the chat. I will I will answer them. If not, I'm going to move on to the next aspect. Each time as I move on, I'm going to come back to the various aspects that we're covering today, and whatever we're covering today, we will refer back to tomorrow and so forth. So throughout the 3 days, whatever we're covering today will be referred back to continuously, because I want to show you when we do an exam question paper, how do we use this thinking when tackling an exam question paper? And this thinking plays a fundamental role in doing in completing a group question without an analysis of equity. I got one question. We just see. Is anyone else? Am I breaking up for anyone else? Okay, so yeah, so it's not my side. So it's we are recording it, so I will share it again. I'll share it once I. So let's move on. So let's move on to the next aspect. Now that we know the basis of group accounting, and we covered two things so far. Number one, it is what is the purpose of group accounting? How does it link to your how does it link to the objective of financial reporting, the conceptual framework? Then we explained how it actually works when it comes to three different entities, the transactions with each other. Why do we eliminate? So the purpose of elimination and the reason for elimination is because the three entities is now becoming one economic entity. And because you are one economic entity, you can't transact with yourself, and therefore it needs to be removed. And more importantly, or equally, is that we only interested in transactions with those outside of the group. I just have one more question I just want to check. So someone also can't hear. Just check the settings. So I think from my side it is clear. So everyone else is hearing. So we just check your microphone. I don't know if you use earphones or something of that nature, because like if you use a microphone or earphones and then you want to listen again via your computer, you need to just ensure that your computer's audio is enabled. Okay, so now that we have that basis, we are now going to have a look at the various financial reporting standards that is applicable with group accounting. So let's have a look with the group accounting. So there are various standards that is applicable when it comes to group accounting. Okay. So one of the first standards is going to be, let me just say, financial reporting standards. Reporting standards that is applicable to group accounting. It's going to be very important, and I'm pretty sure Eunice will follow the same approach. If you use if you conclude incorrectly, or if you use the incorrect standard, even if you do the incorrect thing 100% correctly, you're still not going to get any marks. So, for example, if you have a subsidiary but you treat it like an associate, you're not going to get any marks. So, even if you treat the associate 100% correct, the fact that it's not an associate is the problem. So, just make sure you know when to use which standard, and you need to know which standards are all applicable. So there's quite a few standards that is applicable with financial or with group accounting. So I'm going to list them over here. The first one is IFRS 3. We'll go through each of them soon. The second one is IFRS 10. Oh, did I just do IFRS 10? The next one is IFRS 11. The next one is IFRS 12. You don't have to know this one so in depth, but you kind of need to know it. And then we have IAS 28. We have IAS 27. And then I'm going to skip a line. This is not really part of group accounting, but it gets used often. And that is IFRS 9. So let's understand, what does IFRS 3 deal with? IFRS 3 deals with business combinations. Business combinations. Business combination deals with group accounting at acquisition. So that's very, 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 very important. Note that IFRS 3 is the accounting treatment for group accounting at acquisition. IFRS 10 deals with control. I will explain how this comes together. IFRS 11 deals with joint arrangements. I'll explain all of that when we come to the next section. IFRS 12 deals with disclosure. IAS 28 deals with associates and joint ventures. And then IAS 27 deals with separate financial statements. What is separate financial statements? Separate financial statements is how you treat an investment that the parent made. So for example, when you're looking at ShopRite, the individual company, ShopRite, the individual company, made an investment in Checkers, made an investment in 7-Eleven. Now, IAS 27, separate financial statements, tells you how ShopRite, the separate company, needs to deal with its investment in Checkers and how it needs to deal with its investment in 7-Eleven. You must distinguish that with how ShopRite, the group, will deal with the investment in Checkers and 7-Eleven. So must keep the two separate. From a group perspective, how does ShopRite, the group, deal with its investment in Checkers and 7-Eleven? And then ShopRite, the separate company, how does it deal with its investment in Checkers and 7-Eleven? So when you are looking at the company, the separate company, ShopRite, the separate company, then you use IAS 27. You must please be aware of that. Okay. Then we have IFRS 9. This deals with financial instruments. Financial instruments. So we'll go through this one more time. IFRS 3 deals with business combinations. Business combinations deals with the accounting treatment at acquisition. IFRS 10, IFRS 11, and IAS 28 deals with the accounting treatment of group companies in subsequent, after, at acquisition, since acquisition. Then you have IAS 27. IAS 27 deals with the parent's separate financial statements. How does the parent, in its separate financial statements, how does ShopRite, in its separate financial statements, deal with the investment in Checkers and 7-Eleven? And then you have IFRS 12, which deals with disclosure-related items when you make investments that are subsidiaries, associates, and so forth. IFRS 9, financial instruments, is not relating to group accounting. It relates to financial instruments. But remember, sometimes we have normal investments, and then we have to apply IFRS 9. Also, IFRS 9 is applied when you work through IAS 27. but more on that when we come to the actual question. So before I move on, do you have any questions? Because I'm going to move on to something where we're going to do a table and explain various issues now. I don't think I have any questions. So now I'm going to give you an overview of the various types of investments and how to treat them, the various type of accounting treatment. So the various categories of the table is broken up into type of influence. Then we'll have nature or type of investment, nature of the investment. And then we would have the accounting treatment. Where's this now? The accounting treatment. And then we would have the standard accounting standard. Accounting standard. I just want to format this so it's easier to read. So please make sure you you know this. So there's various types of influence in undergrad, in third year. The type of influence will be given to you, will be told. In CTA 1 to a large extent, CTA 2 also, but in CTA 2 they will ask you to also discuss what type of influence it is. What's very important, and it's actually something that I think all universities do, if they ask you to discuss the influence, and let's say you conclude that it is control, but it's actually significant influence, then you will lose all the marks through the whole question. And that is why in many questions, to avoid that from happening, they will say part one, discuss the type of influence, and then in question two, they will tell you, assume that it is that the company has control. But if the question does not have that, I remember one year at UCT, in one of the tests, they did that. Luckily, it wasn't my year. It was a year ahead of me, where it was like, I think, 100-mark question. And question one was discuss the type of influence. Question two was now, whatever the type of influence you said it was, do the accounting treatment. So let's assume, I can't remember what the accounting influence was, but let's assume it was control. People that concluded differently, significant influence, and then applied significant influence to part two, lost all their marks. And the rationale was that you got number one wrong. Does not mean you got you said it was significant influence and then you correctly applied significant influence. The whole fact of the matter is the whole thing is wrong. It's not significant influence to start off with. So just be aware of that. If you come across questions, just read carefully, look through and see what examiners might mention, whether you actually got marks for doing the right thing, even though you concluded incorrectly, or whether you lose all the marks. And that is why in most questions, if they ask you to discuss the type of influence in part one, part B would then, or part two would then tell you, assume that it is control. Now, here's the second thing on that. If you said significant influence in part A, and then part B said assume control, don't think now your conclusion is wrong, okay? Your conclusion could be right. They just want to test something else going forward. So please don't make that mistake as well. So it does not mean that if you concluded in part one that it is significant influence, and then part two, they say assume that it is control, that your part one is wrong. There's many examiners that actually do that on purpose because they know students is going to try to manufacture the answer to agree to what the assumption is. So just be very, very careful around these type of issues. And the only way you're going to be careful around these issues is if you really understand the theory and you actually apply the theory to the scenario. And the scenario will generally be clear in a subtle way. It's not going to shout at you, but it'll be clear in a subtle way. So this table I'm going to share with you plays a critical role in the rest of group accounting. Because if your conclusion for influence is incorrect, the rest of your question will be incorrect. But if your conclusion is correct, then the rest of your question can be correct, assuming you apply it correctly. So what are the various types of influence? The most common one that we know is control. Then a not so common one is joint control. Joint control, there's two types of joint controls, and we will discuss that now. And in the next one, so control is very common, joint control not so common, and then we would have significant influence, very common, significant influence. And then a common one as well, no influence. And that is where IFRS 9 comes in. When you have no influence, then it's a normal investment, and in a normal investment, you apply IFRS 9. So the nature of the investment is that if you have control, then you have a subsidiary. This is the way of thinking. So when you read a question, you want to read a question to identify what type of influence do you have. One of two things will happen. Either it will be given, or number two, you will have to determine it. In most cases, it's going to be given. So the level of the approach to thinking is as follows. When you read a group question, you will try to identify what type of influence do I have. So if you have control, it means you have a subsidiary. And when you have a subsidiary, you will have to consolidate. Okay. And consolidation, if you have to consolidate, you have to apply IFRS 10. So IFRS 10 deals with consolidation. If you have joint control, you'd have a joint arrangement. If you have joint control, it means you have a joint arrangement. Now, for a joint arrangement, there's more than one. One of it is a joint operation. So if you have joint control, that means you have a joint arrangement. A joint arrangement, one of it is a joint operation. If you have a joint operation, then the accounting treatment is partial consolidation. Partial consolidation. Consolidation. Partial consolidation, where the accounting standard that we'll use for that is IFRS 11. One, like I said, there's two parts to joint arrangement. So if you have joint control, you will have joint arrangements. A joint arrangement could either be a joint operation or it could be a joint venture. For test one, there's not going to be other discussion regarding whether you have a joint operation or joint venture, because joint arrangements and joint control is only tested in test two. Okay, so we're not going to go into the details in this class regarding how do you determine what type of an arrangement it is. So then you have joint venture, and if you have a joint venture, you will have to apply equity accounting. Equity accounting is equity accounting is found in IAS 28. But now remember, for a joint venture, you're going to use IFRS 11 and you will use IAS 28, because IFRS 11 will tell you whether you have a joint venture or not. Once you do have a joint venture, IFRS 11 tells you that now if you have a joint venture, you need to apply equity accounting. And where do you find the details of equity accounting? in IAS 28. If you have significant influence, if you have significant influence, then that means you have an associate. If you have an associate, the accounting treatment is equity accounting. And where do you find the accounting standard for equity accounting? The accounting standard for equity accounting is IAS 28. So that is the way you're going to think all the time. You want to identify the type of influence. If you have control, it means you have a subsidiary. If you have a subsidiary, it means you have to consolidate. Where do you find the accounting treatment for consolidation? Which standard? In IFRS 10. If you have joint control, it means you have a joint arrangement. A joint arrangement could either be a joint operation or a joint venture. If you have a joint operation, then the accounting treatment is partial consolidation. Partial consolidation, we will find that. Which standard? You will find it in IFRS 11. The other type of joint arrangement is a joint venture. The accounting treatment for joint venture is equity accounting. Equity accounting is found in IAS 28. But as you can see under the accounting standard, I have IFRS 11 as well as IAS 28. IFRS 11 tells you that whether you have joint control, and that means you have a joint arrangement, and then it tells you what type of a joint arrangement do you have. Once it tells you what type of joint arrangement you have, it tells you what is the accounting treatment. So IFRS 11 will tell you that a joint venture needs to apply equity accounting. And the details of equity accounting is found in IAS 28. If you have significant influence, it means you have an associate. If you have an associate, the accounting treatment is equity accounting. Where do you find the details of equity accounting? Which accounting standard? IAS 28. If you have no influence, that means you have a normal investment. The accounting treatment for normal investment is fair value. Where do you find which standard deals with the fair value of investment in shares? The accounting standard that deals with fair value relating to investment in shares is IFRS 9 financial instruments. So you need to see how this all fits together, and this will make your life a lot easier. My experience tells me that one of the biggest problems or challenges, we not call it a problem, but one of the biggest challenges is knowing which standard is applicable where. So as you can see, IFRS 3, IFRS 3 is dealt with or is used only at acquisition. So IFRS 3 is used at acquisition, and there are limited instances where IFRS 3 is used subsequently. But once you have dealt with at acquisition, you would also identify the type of influence. Once you know the type of influence, then subsequently you need to apply the accounting standard that is applicable to the type of influence. Okay. Do we have any questions at this point? Okay, any questions? So no questions. So just to recap before we move on to the final part of this lesson, or the second part, or there's two more parts I want to cover. So before we move on, we covered three things so far. We covered the purpose of group accounting. We covered the various the various accounting standards, and then we also covered a table that shows you the type of influence, the type of investment, and then the accounting treatment. And then also explaining the accounting standard that is relevant to the type of influence. Please make sure you can identify this. I do note for some, navigating through all these accounting standards can be challenging. So I hope this basic table will give you some type of mechanism to navigate through all of these accounting standards. So how do we apply I-43? That is what we're going to cover tomorrow. So day one is just a high-level overview. Day two, tomorrow, we will cover how to apply the key principles of I-43 and intercompany transactions. And then day three, which is on Wednesday, we will cover a question. Okay, we'll cover one of the test ones from CTA 2, FAC 4864. So I'm not going to go into the details of I-43 now. That's on the agenda for tomorrow. So now, the next part I'm going to cover, and this is perhaps the most challenging part when it comes to the approach that I take. Remember, it's not my approach. It is just an approach that really works. Why do I say it really works? Remember, what are you preparing for? As a CTA 2 student, from a CTA 1 student, you're preparing for CTA 2. A CTA 2 student, you ultimately want to pass so that you can qualify and actually write ITC. Now, when you write ITC, the chances of you getting a question that you used to, so remember, you're not sure who's setting the ITC exam, okay? It's any lecturer and consultant, so not necessarily going to be a UNISA lecturer. And that means the way the UNISA lecturer thinks would be different because it's not the same person, not the same school. So you need to think beyond the way UNISA tests. And more important than the ITC exam is that when you go to the real world, you're going to need to know how to deal with a group accounting question. You can't tell if you're in audit, you can't tell the partner or the manager. If you're a financial accountant, you can't tell the finance manager or the FD that this is not covered at UNISA. Okay, so just keep that in mind. We're going to follow an approach which will help you to navigate any scenario, any scenario. An intercompany transaction, a transaction that will take place that you've never seen before, and you'll be able to navigate it. It's going to be challenging initially. Why is it going to be challenging initially? Because it's going to get you to actually apply your mind and to actually think. What do I mean by actually think? We are all used to using the analysis of equity. And many of us, I was one of those, that use the analysis of equity because I could just use it, but I did not understand the analysis of equity. So this approach over here is going to challenge your way of thinking, but it's what's gonna help you. It will answer any question, any transaction they give you. You will be able to answer it because you're gonna have an approach to thinking. So no matter what transaction they give you, we might cover the typical intercompany transactions, but there's going to come a time when you're going to get a transaction that you have never seen before, and you will not be able to rely on memory to answer the transaction. But what's going to help you if you can actually understand what you are trying to achieve. And this approach is going to help you. And I'm going to constantly use it over and over and over, because by constantly repeating it, it's actually going to help you. But before I go there, someone raised their hand, I think. Like, I don't even see. I saw someone raise their hand. You want to ask the question? Like, I'm not sure where is his hand raised. Who raised their hand? You want to ask a question? Yeah, so guys, yeah, so Kwena, you raised your hand. Is it for the question you pose in the group, in the chat? I don't know if you heard my response to that. I'm not sure if you heard my response, but basically my response to your question was, so you asked, how do we apply IFRS 3 for all investments at acquisition before applying relevant standards? So I said we're going to apply, I'm going to show you dealing with IFRS 3, how to apply IFRS 3, and the key principles of IFRS 3 will be covered in tomorrow's lesson, day 2. So I'm not going to go through it now. We're going to go through it in quite detail tomorrow. So I hope that answers your question, and I'm assuming that is the reason why you're raising your hand. Okay, so now we're going to move on. There's another question. Okay, cool. Okay, so now we're going to move on. And this is the do all, die all approach to tackling group accounting. Follow this way of thinking, but you must constantly do it. You can't do it once. You can't learn it the day before your exam. You need to do it, learn it, and then constantly apply the approach until it becomes automatic. Until it becomes automatic. And you have to constantly tell yourself, whatever I'm going to tell you now, constantly tell yourself. So when you work through a group accounting question, constantly apply this method till it becomes automatic. So that when you read a scenario, without even looking at the required, you already know what needs to take place. You already know the answer. You want to come to a point when you read a scenario, when you read a transaction, when you're done reading the transaction, you must already automatically, and I'm telling you it happens automatically after you practice, the journal entries and the impact it has on the financial statements without doing it, without setting up the financial statements, without doing analysis of equity. You want to come to that point where when you read a transaction, that you exactly know the journal entries and you exactly know how it will impact the financial statements. So let's get into this. The approach when preparing consolidation. Approach to thinking when preparing consolidated financial statements. Remember, I know this is one of the most challenging aspects through my experience is the journal entries. This approach forces you to think of not exactly force you, but you're going to get it right when you work, when you think through the journal entries. And when we cover things tomorrow, intercompany transactions, I'll take you through the various journal entries and I will explain it to you and explain my way of thinking, how to come up with the journal entries. I know journal entries is one of the most challenging aspects. Besides for at acquisition, with at acquisition we just memorize. But all the others, some of us memorize it, but we can't always memorize it. Maybe in undergrad you can memorize, CTA will not be able to memorize it. And that is why this approach we're going to follow, I'm going to tell you now, it might be challenging, but it's going to be worth it. And I want you to actually spend time when you work through a group question to apply the approach. And if you consistently do it and you grind through this approach, ultimately in the end, you're going to be able to work, you will be able to, this approach will be so automatic in your mind that when you read a transaction, you will automatically be able to think of the journal entries and the impact that it has on the financial statements. So what is this approach? Nothing fancy. You might have heard about it before. I can't actually recall if I saw it in the UNISA, what you call it. I cannot remember certainty, but I do know UNISA always use analysis of equity. But is to follow an approach as this. Where are you and where do you want to be? Okay, so it's knowing where you are and knowing where you want to be. If you don't know where you are and or you don't know where you want to be, coming up with journal entries is going to be extremely difficult. And if I relate this to something that we do every day, if you want to travel somewhere, let's say if you're in Cape Town, Western Cape, and you want to get to UNISA in Paro, but you don't know where Paro is, are you happy that it's going to be very difficult? Ignore GPS now. It's going to be very difficult to go from where you are to UNISA in Paro if you don't know where Paro is. Similarly, if you don't know where you are, you're also not going to know how to get to Paro. So the key thing when it comes to group accounting is to know where you are, which we call in group accounting your starting point, and know where you want to be, which we call in group accounting your end point. How you get there is a vehicle. Okay. What vehicle do we get there? Through pro forma journal entries. So just keep that in mind. The way you go from your starting point to your end point is through a vehicle, and this vehicle is called pro forma journal entries. So what is the starting point? So we want to go from starting point and we want to get to our end point. What is our end point? What is the destination? The destination is our group annual financial statements. So the end point, the final destination is your group annual financial statements. That is where we want to be. What is this group financial statements? If we go back to the beginning of the lesson, where as I explained that diagram, that the group annual financial statement is that square block. It is ShopRite, the group, which is made up of three entities, which we assume to be one economic entity. So your group Fs is that square block, the one economic entity made up of those three individual companies, and it only includes transactions that we have transacted with those outside of the group, and it does not include transactions with those inside of that square, inside of the group. That is your group Fs. You need to know what your group Fs is. You can't hope to get there. You need to know when you get there that that is the answer. You can't like some people think that taking starting point and adding pro forma is going to give you a group point. How are you going to know you're at a destination if you don't know what the destination is? So, in order to know whether you arrived at your destination, you need to know what is the destination. And in this case, the destination is the endpoint, which is your group Fs. What is the group Fs? It is that one economic entity made up of all the separate companies making up the group. And it only includes transactions with those outside of the group, and it excludes transactions with those inside of the group. That's important to know. The next important thing, well, whether in no particular order, but the next one, based on my explanation, is the starting point. Okay, what is the starting point? And this is critical. I'll tell you why it is critical. In one of the years, I'm trying to remember which year. I think it was 2016. Yeah, I think 5 years, about 5 years ago. In 2016, FAC 4864 final exam, October final exam. I think it was 2016. People flocked that exam. I know someone, UNISA generally give you a booklet. I think in fact it is booklet 107, that later 107 or 106. And they give you like a stack of questions. One student went through all of that questions. And when he wrote the final exam, he still he asked my advice. He just came to me for test four, and he asked me advice what he needs to do. And my advice to him was Don't go through all the questions, do just 5. But make sure you learn that 5 thoroughly. But he was more comfortable going through, I think it was like 20 questions. I don't know, it was a lot. And he managed to go through the lot. But when he wrote the final exam for that particular paper, that paper 1, his result was 20%. He actually came to me and then he told me, he actually understand what I meant. And do you know what was the difference? And then I tested that question. I took that question, and the next year I used it in a with one in my fact class, and the same mistake happened. What was that mistake? Students did not understand the starting point. And that is why I want to bring it to your attention. You need to understand what is your starting point. Your starting point is as follows. Your starting point is the sum of your separate trial balances. So your starting point is the TBs of the individual companies, as at the end of the current year. That is your starting point. Your starting point is what? It is the trial balances of the separate and the individual companies as at the end of the current year. That final exam made one slight tweak. What are you used to? You are used to getting ShopRite, Checkers, 7-Eleven, 3 separate trial balances. That particular question gave you one trial balance that was ShopRite plus Checkers plus 7-Eleven. I'm using that name. That's not the names of the question, but that was the concept. The concept was that they just changed the information slightly. What was the slight difference? You have 3 companies. You are used to getting 3 trial balances. In this particular question, you got 3 companies, but you got 1 trial balance. That 1 trial balance was the sum of the 3 trial balances together. What most students thought it was, most students thought it was the group Fs already, which was not. It was just basically the sum of the individual trial balances. That means it was your starting point. That means you still needed to do your pro forma journal entries to get to the end point. And that is what most students missed. And that is why I want to reiterate. What is the starting point? The starting point is the separate trial balances as at the end of the current financial year, not the trial balances at the beginning of the financial year, not the trial balances at acquisition. It is the trial balances at the end of the current financial year. Very, 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 very important. The starting point, I'm going to say again for the last time, it is the trial balances of the individual and separate companies at the end of the current financial year. Your end point, it is what you are trying to achieve, and that is your group financial statements. What is your group financial statements? Once again, it is at one economic entity making up all the individual companies and only including transactions from those outside of the group. Very, very important. Now let's explain this a little bit more in detail. Using the different types of investments, it will always be 100% of the parent. It will always be 100% of the parent. 100% of the parent's separate trial balance. It will always be 100% of the subsidiary. That is 100% of the subsidiary's separate trial balance. More specifically, 100% of the parent's assets, liabilities, income, and expenses, okay, on a line-by-line basis. Similarly, over here, it is 100% of the subsidiaries, assets, liabilities, income, and expenses on a line-by-line basis. What do I mean by a line-by-line basis? It means we're bringing on 100% of the parent and the subsidiaries' revenue, cost of sales, other income, other expenses. That is a line-by-line basis. PPE, intangibles, inventory, what else you get? Debtors, cash. That's what we mean on a line-by-line basis. Very important. Please note that in some exams, they may give you a set of financial statements that some accountant prepared, and then you might have to pick up those kind of anomalies. Okay? So your starting point is 100% of the parent's assets, liabilities, income, and expenses on a line-by-line basis, 100% of the subsidiaries, assets, liabilities, income, and expenses on a line-by-line basis. Which trial balance? It is a trial balance at the end of the current financial year. Then it is 0%. What am I doing? 0% of the joint operation. It is 0% of the joint venture, and it is 0% of the 0% of the associate. This plays a critical role. Understanding your starting point and understanding your end point will have a direct impact on what the pro forma journal entries will be. There's a question, we just see. Yeah, when you say prior to the end of the financial year, what do you mean prior to the end of the financial year? So, I'll put it this way. As opposed to saying the end of the current financial year, we rather put this at the end of the current financial period. So it can be half a year, but generally it's going to be your full financial year. If you can give it a little bit more, a specific example, then I can answer it more accurately. But yes, it's your financial statement that they're going to give you is generally going to be the latest financial statements, and that is what's going to be your starting point. But it's definitely not at acquisition. It will definitely not be the beginning of the current year. If you are busy with the beginning of the current year, then yes, but that means it's just the end of last year. So the TB will be the most recent financial statements, which is generally the end of the current year, but to be more general, let's say the end of the current period. Okay, let me just quickly answer these chat questions. Okay, so that answers your question. So remember, this plays a critical role. Understanding your starting point plays a critical role in your journal entries. But now, what is the end point? The end point is 100%. The end point is the same. The endpoint for parent is the same, but from a group perspective. What do I mean by a group perspective? A group perspective just means, the group perspective simply means that we want transactions only with those outside of the group. So if there's any intercompany transactions, we will make the necessary adjustments. Okay, so group perspective, that means i.e. So group perspective means after group adjustments. We'll come to group adjustments now. Similarly over here, It is 100% of the subsidiary. It's 100% of the subsidiary from a group perspective. So that is why, because the endpoint of because the group financial statements want 100% of the subsidiary, it makes sense to start off with 100% of the subsidiary. So we want 100% of the subsidiary, so therefore we just start with 100% of the subsidiary, and we just make adjustments for any differences between what the group wants and what the separate financial statements have. Same for the parent. The group wants 100% of the parent's assets, liabilities, income, and expenditure. That is why it makes sense to start off with 100% of the parent's assets, liabilities, income, and expenditure. And we simply just make simple adjustments for any differences between what the group wants and what the separate trial balance have. And the differences is basically your group adjustments. I'll come now to group adjustments. Whereas for a joint operation, when it comes to a joint operation, we apply partial consolidation. Partial consolidation means we want our percentage. So we want X percentage of the joint operations, assets, liabilities, income, and expenditure. Okay, once again, from a group perspective. From a group perspective. Now, with a joint operation, you generally want 50%. So generally it's 50-50. So you want 50% of the assets, 50% of the liabilities, 50% of the income, 50% of the expenses on a line-by-line basis. Now, this one, the joint operation, you can either start with 0% and bring on your 50%, or you can start with 100% and then remove 50%. The general approach is to start with 0% and then bring on your 50%. Okay, so joint operations either or. Just read the question carefully. If it's silent, you assume that you brought on 0. I mean that your starting point is 0. So therefore you have to bring on your percentage. For a joint venture and a joint for a joint venture and an associate, it is exactly the same. Exactly the same. The only difference is when it comes to joint venture, we use the word joint venture. When it comes to associate, we use the word associate. Why is it exactly the same? Because they're both using or they're both applying equity accounting in terms of IAS 28. The only difference is if you're dealing with a joint venture, you use the words joint venture. If you're dealing with associate, you use the word associate. Okay? So when it comes to a joint venture and an associate, when you apply equity accounting, you do not want assets, liabilities, income, and expenditure on a line-by-line basis. You don't want that. That is why we start with 0%. It does not make sense to start with 100% and then remove 100%. It makes more sense to start with 0% and only bring on that what we want. So what is it that we want? From when it comes to equity accounting, all that we want is our share of the profits and the investment in associate, the investment in joint venture. So all we're going to do is bring on our percentage, our percentage of net profits and the investment in JV. Similarly, for associate, we're going to bring in our percentage of net profits and the investment in associate. So when it comes to what we bring on from an income statement point of view is simply earnings from associate, earnings from joint venture, other comprehensive income from associate, other comprehensive income from joint venture. All we want from a balance sheet perspective is investment in joint venture, investment in associate. And that is the reason why the starting point is zero. There's no point to start off with 100% of the trial balance of an associate or joint venture and then only to remove 100%. It makes much more sense to start with zero and only bring on that what we want. We only want three things. Basically, we only want two things: our share of the income statement and the balance sheet. Our share of the income statement is two things: share of profits, share of OCI. And then from a balance sheet perspective, it is one thing. It is only our investment in associate, our investment in joint venture. And that is the reason why our starting point is zero, because then the journal entries that we need to do is far, far less. When it comes to the parent and a subsidiary, the group wants 100% of the assets, 100% of the liabilities, 100% of the income, 100% of the expenditure on a line by line basis. And that is why it makes more sense to start off with 100% and then just make any minor adjustments for differences between the group perspective and the separate financial statements. So I hope you can see that why in some cases we start with 100% and in other cases we start with 0%, because it all is dependent upon what we want in the group financial statements in the end point. So how do we move from starting point to end point? The way we move is through group adjustments. Which is known as pro forma journal entries. The reason why it's called pro forma means not real, okay? Pro forma means it is not real. We're not actually adjusting the separate trial balances. The Shoprite's trial balance is remaining Shoprite's trial balances. We only processing journal entries in Excel to account for differences to get to the group Fs, and that's why we call it pro forma. Obviously, in the real world, if you think about Old Mutual, if you think about Sanlam, I think Sanlam has like, I think 1,000 subsidiaries. 1,000, right? 1,000 subsidiaries. Just imagine this. I'm like, 1,000. I was in an interview and they told me they have 1,000. I was like shocked. So if you think about that, having 1,000 pro forma journal entries in Excel is not going to work. So the accounting software to deal with this. But what you should know, these journal entries to account for group adjustments does not change the separate financial statements. It is only adjusting the separate financial statements to get to a group perspective. So to think it on a smaller scale, think of it like this. Your starting point in Excel will be the separate trial balance of the parent and the subsidiary. So column A, column B will have all the numbers for the separate trial balances for the parent and the subsidiary. That is never going to change. That is what it is. That is what the separate financial statements will look like. But now we're going to prepare the group financial statements. The group financial statements will have some differences because from a group perspective, we are only interested in transactions with those outside of the group, and we are not interested in transactions with those within the group. So therefore, there will be some differences. So to get to the group financial statements, we process entries through Excel, which we call pro forma, non-real, artificial, if I can put it that way, just to get to our group financial statements. So just try to picture that. Our group adjustments are twofold. On a high level. There are two types of group adjustments. Number one, it is adjustments. relating to transactions at acquisition. This we'll cover when we deal with IFRS 3 tomorrow. And that is why I kept IFRS 3 and intercompanies together. And then number 2, it is intercompany transactions. There may be other stuff, but these are the typical group adjustments. Okay, the same thing applies over here. So your typical adjustments, it is adjustments relating to transactions at acquisition. So for example, at acquisition, there was a fair value adjustment for PPE. So the cost price for the cost price for the separate entity is different to the cost price for the group. The cost price for the group is the fair value, whereas the cost price for the separate entity is the original purchase price. And therefore, because the cost price is different, the depreciation will be different. So we need to account for that difference and so forth. Intercompany transaction, let's, for example, be a sale of inventory. So included in the profit of the parent is profits made within the group that is considered to be unrealized, and therefore we need to remove it, because from a group perspective, we only want transactions outside of the group. So those are type of stuff just to be aware of. So remember what is the starting point, and remember what is the end point. The starting point, the separate trial balances as at the end of the current year or as at the end of the current period. And your end point is what the group wants. It is the group financial statements. And as you can just look at the columns I jotted in. The way you're going to move, the way you're going to travel from your starting point to your end point is through your vehicle of pro forma journal entries, which is your group adjustments. On a high level, your group adjustments is made up of two things. Adjustments relating to transactions at acquisition and then intercompany transactions. If you have any other questions, you can let me know, but that is basically what I wanted to cover for today. So let me know if you have any questions, then I'll just take 2 minutes to recap what we covered, and then we can call it a night. Do you have any questions? I'll give like a few seconds. Anyone have questions? Okay, doesn't look like anyone is typing, but you can still ask while I do the recap. So to do the recap, what did we recap? Let's just go from the top. So from the top, before we covered this, this just became a bit messy now because I shifted the cells. But from the top, we covered what is the purpose of group accounting, and we linked that to the conceptual framework. Okay. Then we covered this diagram over here to just give you an understanding of what is a group. So you have the separate you have the separate entities. Each entity will most likely be a separate legal entity. In terms of the Companies Act of South Africa 2008, each separate legal entity must prepare a set of financial statements. So Shoprite will have its separate financial statements. Checkers will have its individual financial statements. 7-Eleven will have its individual financial statements because it is a separate legal entity. But now we want to prepare group financial statements. When you look at the group financial statement, we look at the three entities together as if they are one economic entity. And therefore, because we are one economic entity, we are only interested in transactions with those transacting with the economic entity, and that is those outside of the group, and not with those inside of the group, because those inside of the group is one and the same, and we can't transact with ourselves. And that is the reason for eliminating or removing intercompany transactions. We then went through and discussed the various accounting standards that applies to financial reporting. And we went through IFRS 3, IFRS 10, IFRS 11, 12, IAS 28, 27, and how does IFRS 9 link up with group accounting. Then we went through this table over here, which is the type of influence, the nature of the investment, the accounting treatment, the accounting standard. Remember to identify what is the type of influence, because the type of influence will determine the nature or the type of investment. The type of investment will tell you the accounting treatment. The accounting treatment will lead you to identify what is the applicable standard. Then we dealt with this important part, which is our group adjustments. Our thinking approach. Okay, so then we dealt with this thinking approach. The thinking approach when it comes to group accounting is to identify what is your starting point. Your starting point will be the separate trial balances as at the end of the current period. Remember, it is only 100% of the parent, 100% of the subsidiary, 0% of everything else. Your end point is what the group wants. It is the group annual financial statements. You need to know the destination. You need to know what is it that the group wants. From a parent perspective, the group want 100% of the parent, but from their perspective, the group's perspective. When it comes to the subsidiary, the group wants 100% of the subsidiary, but from their perspective, the group's perspective. When it comes to a joint operation, the group only wants their percentage, but their percentage of every asset, liability, income, and expenditure on a line-by-line basis. When it comes to a joint venture and a joint and an associate, the group only wants their share of the net profits so their share of the income statement as their share of profits, their share of OCI. And then from a balance sheet perspective, they only want to show an investment in associate, an investment in a joint venture. That is very different to what they want from a subsidiary. From a subsidiary perspective, they don't want the net profit. They want every line item. Similarly, from a balance sheet perspective, they don't want investment in subsidiary. They want every asset and liability on an individual, on a line by line basis. To conclude, why does that make sense? Um, from a subsidiary point of view, you control the subsidiary, and therefore you have a big say on every line item. And that's why it makes sense to show every single line item, because you control every single line item. Whereas when it comes to an associate or a joint venture, you only have significant influence. So you can't necessarily have a massive say. You can only influence it to some degree, and therefore you only show your investment in an associate and you only show your share of the profits. So just keep that in mind, understand the why to make so that it makes it a little bit more easier. And that's it from my side. I hope you guys found it beneficial. Tomorrow, we're going to do IFRS 3 and cover the key principles of IFRS 3. And then we'll also cover the 2 to 3 main intercompany transactions. If you have any questions, let me know. If you don't have any questions, you're free to go. I hope you found it fruitful and beneficial. Thank you, guys. Okay, so there's no questions, so I'll just end the lesson over here. I'll give 10 more seconds, and then I'll just end the lesson.